The Treasurer, Jim Chalmers, says the economy is not heading towards a recession, despite Australia's weak economic performance. Yesterday's figures from the ABS showed the nation's GDP, or economic output, rose by just 0.1% in the March quarter.
The definition of a recession is a couple of quarters of negative growth, and we haven't had any quarters of negative growth. We're unusual in the world in that regard. I think something like 3/4 of OECD economies have had a negative quarter and we haven't. And so we're not contemplating that outcome here. The Treasury forecast, the Reserve Bank forecast and others expect our economy to continue to grow.
Now let's delve a little bit deeper and bring in the Bank of Queensland's Chief Economist, Peter Munckton. Morning, Peter. As you heard, the Treasurer says we will not fall into a technical recession, but that doesn't really match the reality of what people are feeling day to day, right?
Well, I agree. I'll start off. I agree with the Treasurer that technical recessions, 2 negative GDP numbers in a row. We haven't had that yet, and I don't. The June quarter will probably be a low plus GDP growth number, but not a negative one. So I agree with the Treasurer that we won't get a technical recession. Quite often, recessions, you get that feeling that it's bad because unemployment rates picked up a lot. And what's very unusual, of course, is that people don't feel great, but the unemployment rate remains really low. In fact, the number one issue for a lot of businesses is the fact they still can't get workers. So in that respect, it's not like a typical recession, how you feel it. Why do we feel, though, that things are not great right now? And that certainly is the case. Ask many households, and they'll tell you that things are not great right now. And the big issue is that their incomes, once you take out tax and once you allow for interest rates and rents, the biggest issue for households is that their incomes just haven't been able to keep up with inflation. And so that's the real big reason why our economy sort of struggled in the last few quarters. It's a bit of an issue that remains for the current quarter. But I was just going to sort of say, David, that's been the big issue for our economy for the last 12 to 18 months. Going forward, there are plus signs for the households' incomes. Wages growth is now above the inflation rate, A, and then B, of course, the tax cut. So the biggest problem we've had for an economy, which has been our big negative right now, is slowly will be turning a positive. So that circle, that wheel is turning in a positive direction.
Well, that is true. The Treasurer does expect the economy to keep growing, so there'll be progress there, Peter, but that also depends on people increasing their level of spending to some extent. So what are we spending our money on, and who in particular is doing the most spending during this cost of living crunch?
Yeah, so the first bit is that there are people outside households are doing the spending, and infrastructure work, data centres, green energy transition, they're all big things. The government obviously is spending monies on things like the NDIS program. What about households? Because the households are 55% of the economy. Where are we spending our money? There's stuff that we have to spend money on. Food, a really obvious example. And then there's stuff that we just want to have a good time. It's sort of something that we feel like we must do, and that's things like Taylor Swift and the F1. Sort of big events. We really feel like we need to be there. So they're the things where households are spending their money right on. Some people are lucky enough they've been able to spend their money by going overseas from an economic standpoint because the other people get the benefits of that. It's not in our GDP numbers. But that's where the households are spending. If, though, we're doing it tough and we're spending it in those areas, obviously there's some areas we're not spending it. And, for example, we're not going out as much. We're not having coffee as much in terms of takeaway coffees as much as we used to. So some areas we're spending because we either need to or really want to, but that's meant in some other areas we can't. And that's some of those discretionary sort of areas.
Yeah, Peter, if Australia's economy continues to grow at such a slow pace because we're not spending as much on coffee and other things, what would that mean for jobs and people's overall living standards here? Yeah,
so the biggest issue we've had as an economy, as I mentioned, over the last 2 or 3 years, is we've essentially had more jobs than people. We've just really been short of workers. And one of the things as the economy's slowing, that is sort of slowly turning. And in some industries, employers have found it easier to get people. But in some industries, it still remains very, very, very difficult to get workers. Right? So, yes, it's the fact that in areas of accommodation and food services, those are areas where basically there's less spending, less need for people. But if you actually look at areas such as teaching, health, in none of those areas, industries are still well short of workers. So what we end up doing is we'll stop working in some areas, we're starting working in other areas. I suppose the big picture is what Treasury, the RBA, what most economists are saying is that, look, we have sub-trend growth right now. What that typically does mean, what we're starting to see, it means a slower jobs market. Slower jobs market means some rise in the unemployment rate. So it does mean the unemployment rate is likely to rise from where we are. But given how short of workers we are right now, I think the rise in the unemployment rate is likely to be quite modest. In other words, a 4.5% perhaps peak in the unemployment rate, which by historical standards is still quite low.
And for people who are worried about unemployment or if they're paying off a mortgage, the question on their minds, no doubt, when are interest rates going to come down, Peter?
That is sort of a really, really big question, isn't it, David? What we've got right now is basically an unemployment rate about 4, which is low, and an inflation rate around about 4, which is high. And if you've got those two combinations, it's very hard to get cuts in interest rates. In actual fact, financial markets every now and then, a toss up about whether the next move could be up, right? So if you've got those two numbers, 4 and 4 of the inflation and unemployment rate, you can't be cutting rates. I think as we go through the year, I think we will see the inflation rate come down. I think as we go through the year, we'll see some rise in the unemployment rate, but we've got to be certain that those two things are happening because we can't have the inflation rate too high for too long. So the first bit is cut interest rates. I think the next move will be down, but it may not be for some time, and some time may not be until early 2025. That's the first bit. And the second bit is, how much will interest rates be cut? And that will depend upon, what does the economy look like this time next year and how much further progress have we made on the inflation front.
So it looks like people who want mortgage relief might have to wait a while. Peter, thank you very much for your insights.
Thanks, Dave.